For nearly 60 years, Warren Buffett has led Berkshire Hathaway, delivering an astonishing, legendary average 20% annual return to investors since 1965. His recent announcement confirming his retirement from the CEO role at year-end, handing the keys to Greg Abel, leaves the market with one critical, terrifying question. For the first time since 1965, this $1 trillion empire will be run without its legendary founder. That is a huge deal. In this video, we discuss what happens next, how Berkshire is actually built to thrive without Buffett, and the crucial difference between the short-term emotional noise of the stock and the long-term fundamentals of the business. Module 2. The 3 Pillars of the Berkshire Empire. To understand the future, we must first understand the structure Buffett built. Berkshire is not a single company, it is a 3-pillared empire. 1. Wholly owned insurance businesses, e.g. Geico, National Indemnity, the bedrock and the capital engine. 2. Other wholly owned businesses, e.g. BNSF Railway, Berkshire Hathaway Energy, See's Candies, diversified industrial and consumer assets. 3. Stock portfolio, minority stakes in publicly traded giants, e.g. Apple, Bank of America, Coca-Cola. This currently sits alongside a massive $344 billion cash reserve, succession solved. The wholly owned pillars. For the vast majority of Berkshire's operations, pillars 1 and 2, there is no need for panic. The reality: Buffett has acted as an overseer, not a daily manager, for decades. Each business is run by an independent, high-quality management team. The leadership. The transition is already complete in practice. The insurance businesses are managed by the legendary Ajit Jain, whom Buffett once famously called the man to save in a sinking boat. All non-insurance operations, and now the entire CEO role, belong to Greg Abel, who joined in 2000 and has a proven track record leading Berkshire Hathaway Energy. The confirmation. As Buffett stated in 2021, Abel and Jain are 2 all-stars and first-class human beings. The operating engine of the company is already running on autopilot under designated successors. The most challenging role to replace is Buffett, the legendary stock picker, the man who compounded capital at 20% annually for 6 decades. You can't just find a guy like that. The new capital allocator, Greg Abel, will have the final say on everything, including major investment decisions and how to deploy the massive $344 billion cash reserve. That's pressure. The investment team. He's supported by investment managers Todd Combs and Ted Weschler, who already manage a decent chunk, roughly 10%, of the public portfolio. The philosophy is the shield Buffett spent decades hardwiring a culture of long-term thinking and disciplined capital allocation across the entire company. Abel's primary job is not to find the next Apple. His job is to protect the capital base and live by Buffett's Rule 1. Never lose money. This structural philosophy is designed to endure. It's virtually unbreakable. This is the core tension for shareholders, fam. What happens to the stock price? The emotional voting machine, the panic phase. When Buffett reconfirmed his step-down, the stock dropped 5.5%. The market is guaranteed to have an emotional knee-jerk sell-off when the iconic leader eventually passes away. The risk is hype. Headlines and emotional sentiment, not logic, period, will drive billions in selling. Institutional investors may rebalance, and some funds may be forced to dump the stock due to mandate changes. The result is clear. Expect a steep, dramatic drop in the stock price, completely detached from the underlying business health. That is your signal. The fundamental weighing machine, the real value. Buffett's own wisdom holds true. In the long term, the market is a weighing machine. It will inevitably focus on the current value of all future Berkshire cash flows. The resilience. The business is built like a tank. It owns America's most stable cash cow companies, BNSF, BHE, Geico, The public portfolio will not stop generating profits. The Apple parallel. When Steve Jobs passed, Apple's stock wobbled hard, but the stock ultimately rallied because the quality of the business and its cash flow was stronger than the loss of the founder's genius. The conclusion: your opportunity. The transition will come with volatility. But the underlying machine is so strong, so diversified, and so well capitalized that the long-term trajectory remains undeniably solid. The real story is the power of business fundamentals and disciplined capital allocation. Be ready to buy. Berkshire's future remains incredibly bright, built on a structure designed for longevity. The challenge for investors is simple: separate the temporary fear from the permanent value. This is your test. Action 1. Expect volatility. Prepare mentally for the headlines and the likely steep drop. View this potential sell-off as a chance to buy the dip, period. Do not panic sell. Action 2. Focus on cash flow. Track the company's operating performance, not the daily stock price noise. If the cash flows remain strong, the stock will recover. No cap. Action 3. Bet on the culture trust that the long-term, highly disciplined, never lose money culture instilled by Buffett is the real asset. FAM, now safely guarded by Abel and Ajit Jain. We believe in these leaders and the structural integrity they inherit. The Berkshire machine is built to endure. If you want to learn the fundamentals that allow you to invest with this kind of long-term confidence, come join the Grow Wealth Together community. Smash that subscribe button below for more fundamental investment analysis. Tell us in the comments below, what's your play? Is the emotional sell-off a buying opportunity or a warning sign?